Usually when we talk about a medical diagnosis, there's this expectation of pure, unfiltered precision.
Right, like an exact science.
Exactly. It is almost like engineering. I mean, you fall off a bike, you break your arm, you go to the hospital, and the x-ray shows that jagged white line on the black background.
Hmm.
And the doctor just points to the screen and says, well, there it is.
Yeah, it's binary. The bone is either broken or it is intact. There is really no gray area to debate.
It's clean. And psychologically, that is incredibly comforting.
Oh, for sure.
We as humans, we just love things to be visible, to be categorized, to be mathematically certain.
Because, certainty removes anxiety. When you know exactly what is wrong, you can immediately begin executing the mechanical steps to fix it.
Right, like putting on a cast.
Exactly. A cast, 6 weeks of rest, some physical therapy. The protocol is firmly established.
But then you step into the world of active trading, into the financial markets.
And that's where it gets messy.
Completely messy. Suddenly, that x-ray machine is just broken. We are looking at a diagnostic landscape that is, well, honestly, it's murky.
Highly murky.
For the vast majority of retail traders out there, they are operating entirely in the dark.
Yeah, they really are.
They are trading on gut feelings, they are trading on the 24-hour news cycle, or worse, on the sheer panic they feel when they log into their brokerage app and just see a sea of red numbers flashing at them.
It is the absolute definition of diagnostic muddy waters.
Yeah.
I mean, the average retail investor is operating on emotion. They operate on narrative or on whatever the loudest voice on social media happens to be shouting that morning.
Which is terrifying when real money is on the line.
It is. They're relying on noise rather than empirical, cold data. And in modern financial markets, well, operating on narrative is essentially financial suicide.
Which brings us to the mission for today's deep dive. So welcome to you, the listener, to a highly anticipated special edition.
I'm really excited for this one.
Me too. We are calling this the Bulls, Bears, and the Bell Stockwatcher Show.
A great title.
Thank you. And the mission we have mapped out today is simple in theory, but notoriously difficult in practice.
Very difficult.
We are completely stripping away the emotion. No gut feelings.
None at all.
No loyalty to your favorite smartphone brand. No allegiance to your favorite electric car company just because you happen to like the CEO.
Right. None of that matters today.
Exactly. No panic selling because some pundit on TV started yelling about the end of the economy. Today is about ruthless, emotionless, 100% mathematical trading.
Pure technical analysis.
Pure technical analysis. Strict risk-to-reward ratios. Cold, hard data. We are basically putting the market into the x-ray machine today.
And honestly, it is the only mathematical way to survive in the current macro environment.
Yeah.
Yeah, because when you let narrative dictate your capital allocation, when you buy a stock simply because it feels right, you actively become liquidity for the institutions.
Wow, liquidity. You become their fuel.
Exactly. The algorithms running Wall Street, they do not feel fear. They do not feel greed. They operate purely on mathematical thresholds.
Right.
If you aren't playing their game by their rules, you are their prey.
Okay, let's unpack this. I want to build a visual for you, the listener. Think about navigating the stock market right now like flying a commercial airplane through a massive, heavy storm.
Okay, I like this.
So you are the pilot. The turbulence is violently throwing the plane around. Your stomach is dropping into your shoes.
So awful.
It is. Lightning is flashing violently outside the window, and every single human biological instinct you possess is screaming at you to pull the yoke, to react to the chaos you are feeling in your gut.
Which is the worst thing you could do.
Exactly. A trained commercial pilot, they are taught to ignore their stomach entirely.
Right.
They're taught to ignore the window. They stare dead ahead at the instrument panel. They trust the dials on the dashboard, the altimeter, the artificial horizon, the airspeed indicator.
Because the instruments don't lie?
Yes. If the artificial horizon says you are flying level, you are flying level, regardless of how terrifying the storm feels outside. So today, we are giving you that instrument panel.
And I have to say, that instrument panel is critical right now because the macroeconomic storm outside the window is severe.
It really is.
If we analyze the tactical equity sources we are diving into today, the overarching theme defining this specific moment in time is a bifurcated market.
Okay, bifurcated, meaning split completely in two. A market actively fighting itself.
Exactly. On one side of the coin, we have this incredibly resilient economic growth.
Right, the consumer is holding up.
Yeah, consumers are still spending, Certain sectors are booming, unemployment remains manageable.
Okay, but what about the other side?
Well, on the other side, that exact same economic resilience is actively fighting against re-emerging inflationary risks.
Inflation. The ghost we thought we busted.
Right. We thought inflation was beaten, but the structural costs of living and doing business are creeping back up.
So it's a tug of war.
A massive one. This dynamic is pulling the market in two entirely different, highly volatile directions all at once. It's creating immense turbulence.
And to navigate that turbulence, to fly this plane entirely on instruments, we are going to extract 5 specific actionable stock setups from a dense tactical equity analysis report.
We are building a mathematically balanced portfolio.
Yes, we are. And we aren't just going to throw ticker symbols at you and wish you luck.
No, that wouldn't be very helpful.
We are going to provide the exact geometry for every single candidate. We will outline precisely the entry triggers.
The exact prices.
Yes, the exact prices. The target holding horizon, meaning how many weeks or months the math says you should sit in the trade.
Right.
We'll tell you when to take profits, and crucially, the exact stop-loss level to protect your capital.
The stop loss is everything.
It really is. Because without a strictly defined stop-loss, you aren't trading. You're just gambling with better vocabulary.
That is a great way to put it. The stop loss is your emergency eject button. And the mathematical discipline requires that this eject button is programmed into the system before you even enter the cockpit.
Oh, so you don't decide on the fly.
Never. You don't decide when to panic while the plane is going down. You decide your exact maximum tolerable loss while you are still safely on the runway.
I love that. So before we look at the specific individual stocks, we need to calibrate the macro dashboard, the overarching rules of engagement for this bifurcated market.
The big picture stuff.
Right. What are the specific broad market dials on our instrument panel that we absolutely need to be monitoring right now?
Well, according to the tactical sources, there are 2 primary macroeconomic triggers that every single trader must have on their screen right now.
Okay, what's the first one?
These are the inputs that the institutional algorithms are hyper-focused on. The first is Brent crude oil.
Oil.
Yes. The strict mathematical threshold you need to watch is if oil rises past $102 per barrel.
Wow, okay, 102. And the second?
The second dial is the 10-year Treasury yield. The breaking point there is 4.72%.
So Brent crude oil at $102 and the 10-year Treasury yield at 4.72%.
Those are the magic numbers.
I want to pause here because, it's so easy to just throw numbers around. I want to deduce why these specific digits act as tripwires.
Let's break it down.
If oil hits 102, that's not just pain at the gas pump for regular people like us. Oil is the baseline cost of literally everything in the global economy, right?
Absolutely everything.
So if oil spikes, every shipping container costs more to move. Every factory costs more to power.
Every piece of plastic packaging gets more expensive.
Exactly. It eats directly into corporate profit margins across the board.
That is the fundamental mechanism. When Brent crude breaks $102, it signals to the market that structural inflation is not just sticky, it is aggressively re-accelerating.
It's coming back with a vengeance.
Right. Energy acts as a universal tax on both the consumer and the corporation.
A universal tax. I like that phrasing.
Yeah, and when that energy tax gets too high, consumer discretionary spending drops. And consequently, corporate earnings forecasts have to be slashed.
But wait, the real danger of oil breaking 102 isn't just the earnings, is it? It's the secondary reaction it forces from the Federal Reserve.
Precisely. The Fed.
Because if inflation is accelerating due to energy costs, the Fed can't cut interest rates like everyone hopes. They might even have to raise them.
Which brings us right to the second dial on the dashboard.
The 10-year Treasury yield hitting 4.72%.
Yes.
Let's break down the mechanics of the 10-year yield for a second. Why is 4.72% the specific number that makes the algorithm start hitting the sell button?
It all comes down to the concept of the risk-free rate and how that rate alters the fundamental valuation of high-growth equities.
Okay, let's look at the math.
The 10-year Treasury is essentially a guaranteed risk-free return backed by the United States government.
Because the government can always just print more money to pay you back.
Exactly. Zero default risk. So if that yield climbs above 4.72%, suddenly large institutional funds look at their portfolios and have a realization.
What do they realize?
They say, wait a minute, I can get a guaranteed zero risk return of nearly 5% just by lending money to the government.
Right.
Why on earth am I risking my capital in highly volatile, high-beta tech stocks that could drop 20% overnight on a bad earnings report?
That makes total sense. And high beta, just for the listener, meaning stocks that move with significantly more volatility and speed than the broader S&P 500.
Yes, your massive tech flyers.
Yeah.
Your momentum stocks.
So the higher the risk-free rate goes, the less attractive that risk becomes. But there's another layer to this, isn't there?
There is a deeper mathematical layer, yeah.
Because it's not just about alternative investments. The yield actually changes the mathematical value of the tech companies themselves through the discount rate.
This is where the algorithmic models take over completely.
Okay, explain the discount rate.
High-growth tech companies, say an artificial intelligence startup or a massive software firm, they are heavily valued based on their future cash flows.
Not what they make today.
Right. Investors are bidding them not for the profit they make this year, but for the massive profits they are projected to make in 2030 or 2035.
The promise of tomorrow.
Exactly. But $1 in 2035 is not worth $1 today. You have to discount those future earnings back to the present value.
Because of inflation and opportunity costs?
Right. And the interest rate is the gravity in that mathematical equation.
The gravity. Okay.
The 10-year Treasury yield is the primary input for that discount rate. When the yield goes up, discount rate goes up.
And when the discount rate goes up?
When the discount rate goes up, the mathematical present value of all those future billions in tech profits shrinks dramatically.
Wow. It just evaporates on paper.
It is simple financial gravity. When the yield hits 4.72%, the algorithms don't sit down and read the news. They don't care about a product launch.
Right. They just run the math.
They just recalculate that gravity formula. They see that the future cash flows of the tech sector are suddenly worth 15% less in today's dollars, and they automatically initiate broad selling pressure on high beta growth stocks.
It's a complete chain reaction. Oil hits 102, which implies sticky inflation.
Right.
Which keeps the 10-year yield high, pushing it to 4.72, which crushes the present value of future tech earnings, which finally triggers the algorithms to dump high beta stocks.
That is the exact sequence of events.
So the modern trader has to view these macro indicators not as like interesting opinion pieces in the Wall Street Journal, but as cold binary inputs.
Yes. If X happens, execute Y.
If oil hits 102, prepare for the tech sell-off.
That is the discipline.
But let me challenge this for a second. Let me push back on behalf of our listener.
Go for it.
It is incredibly easy for us to sit here with our microphones in a quiet room and say, oh, just ignore the storm, trust the math, act like an algorithm. But is it really possible for retail traders, I mean regular people with mortgages and car payments, to act like emotionless machines when their own hard-earned capital is evaporating on a red screen?
It's incredibly difficult.
Right. Human biology is wired to run away from pain. When a stock you own drops 10% in an hour, your brain literally releases cortisol.
Yes, it's a physiological stress response, fight or flight.
Exactly. So how do you override biology with math?
Well, it is the single hardest aspect of trading, which is precisely why the vast majority of retail traders fail to beat the market over a 10-year horizon.
Because they panic.
They allow cortisol to make their financial decisions. The only proven way to achieve that algorithmic discipline is by removing the decision-making process entirely from the moment of panic.
Oh, I see.
You do not decide what to do when the plane starts shaking. You decide your emergency protocols before you take off, and you hard-code them into your brokerage platform.
You're talking about the stop-loss order again?
Yes. If you calculate your maximum mathematical risk, and you place a hard stop-loss order that physically resides on your broker server, the emotion is bypassed entirely.
Because the computer does it for you.
Exactly. If the stock falls, you don't have to debate whether to sell. You don't have to agonize over it. The machine executes the loss automatically. You just accept the math and move on to the next setup.
You build the architecture of the trade in advance. You set it and you forget it.
That's the only way.
Which perfectly sets up our first mathematical candidate on the board today.
Let's get into it.
We are going to look at a classic piece of consumer technology, but we are analyzing it purely through the lens of a very specific technical pattern, the V-shaped breakout.
A very powerful pattern.
Let's talk about the largest company in the world, Apple, ticker AAPL.
Apple presents a highly compelling technical and fundamental setup right now.
What are the sources saying?
The tactical sources indicate we are looking at the chart structure leading into its fiscal third quarter earnings report, which is scheduled for July 30, 2026.
Okay, so coming right up.
Right. And the technical data reveals a picture-perfect V-shaped recovery pattern on the daily chart.
Okay, so a V-shaped recovery. For the visual learners listening, this means the stock was trending along, fell sharply and violently over a very short period, found an absolute bottom, and then rebounded upward with the exact same violent momentum.
Forming a literal symmetrical V on the chart.
Exactly. There's no U-shaped rounding bottom. There's no long period of sideways consolidation, just a sharp drop and an immediate aggressive rejection of those lower prices.
And that aggressive rejection is the key.
Yeah.
In late June, Apple hit a local low of $273.77.
The sellers were in complete control there.
They were. But the second it hit that exact price, institutional buyers stepped in with massive volume.
They just souped it all up.
Yeah, and the stock staged a relentless rally, erasing all the previous month's losses in just 4 weeks. It is currently trading right around the $333 level.
It bounced like a tennis ball on concrete.
It really did.
And the fundamental backdrop driving this chart strength is robust. I mean, the street is projecting revenue for this quarter to land somewhere between $107.2 billion and $110 billion.
Massive numbers.
But here's where it gets really interesting. Usually, the mega cap tech stocks, the Magnificent Seven, they kind of trade in a pack.
Right, they move together.
Yeah. If Microsoft or Alphabet catches a cold, Apple and Meta sneeze. But right now, Apple is diverging. It has massive relative strength compared to its peers.
It stands out.
Why is the market rewarding Apple specifically while the rest of big tech is struggling with that high-yield gravity we just talked about?
What's fascinating here is the underlying cause of that relative strength. It comes down to capital expenditures, commonly known as CapEx.
Okay, CapEx.
If you look at Microsoft, Alphabet, Amazon, Meta, they are currently locked in a trillion-dollar arms race to build out massive artificial intelligence infrastructure.
The AI wars.
Exactly. They are purchasing hundreds of thousands of NVIDIA GPUs. They were building monolithic data centers. They're even trying to secure nuclear power plants just to cool the servers.
It's insane. It's an infrastructure build-out on a scale we really haven't seen since the railroad booms of the 1800s.
That's a great comparison.
And laying all that track is incredibly expensive. It is draining their free cash flow.
Precisely. They're spending tens of billions of dollars every single quarter on the promise that AI will eventually generate a return on investment.
Someday.
Right, someday.
Right.
And the market is starting to get nervous about the size of those bills.
But Apple is different.
Apple has a fundamentally different architectural strategy. They have a significantly lighter AI infrastructure footprint.
They aren't building giant data centers in the desert.
No, they aren't trying to build the world's largest underlying foundational models from scratch. They are partnering where necessary, like with OpenAI, and they are focusing heavily on edge computing.
Edge computing meaning running it on the device itself.
Exactly.
Yep.
Running smaller, highly efficient AI models directly on the iPhone or the Mac using their proprietary silicon.
So they are basically letting everyone else lay the incredibly expensive train tracks?
Yes.
And Apple is just going to run their pristine, high-margin luxury trains right over the top of them.
That is exactly how the market is interpreting it.
The market looks at that and says, Apple isn't burning its cash reserves on an unproven data center arms race. Their margins are safe.
It makes total sense, fundamentally.
Yeah, it does. But we are here to trade the math. Let's look at the instrument panel.
Let's do the numbers.
What are the strict mathematical trade parameters for Apple? How do we execute this V-shaped breakout?
Well, the blueprint requires precision. We do not just buy Apple right now at 333 and hope it goes up.
No hoping.
No. The tactical execution order is a buy-stop order. Your specific entry trigger is exactly $335 even.
Okay, let's unpack the mechanics of a buy-stop order for the listener because it is a very specific, highly strategic tool.
It is.
I like to compare a buy-stop order to setting a mouse trap.
Oh, I like this analogy.
When you have a mouse in your house, you do not chase it around the kitchen with a broom. That is exhausting, it's emotional, and it usually ends with the mouse escaping.
And you looking foolish.
Exactly. Instead, you study the mouse's path. You set the trap at a highly specific location, you bait it, and you wait.
Right.
With Apple, I'm looking at the chart, and I can see there's heavy resistance right at $334.99. Every time it gets near $335, the sellers push it back down.
It is a ceiling.
It's a hard ceiling. So we set our trap at exactly $335.
It's above the ceiling.
Right. If the stock hits $335, it means it has finally broken through that ceiling. The momentum is real. The buyers have overwhelmed the sellers, and the trap snaps shut. Your broker automatically buys the stock for you at the exact moment of the breakout.
Yes.
If the stock gets rejected again and falls back to 325, you never buy it. You don't chase.
It is a mechanism of forced patience. You are demanding that the market prove its ultimate strength to you before you commit a single dollar of your capital.
Proof first.
Yes. You are only buying into confirmed, undeniable momentum. So, assuming the momentum is real, the stock breaks 335, the trap snaps, and you are now holding shares of Apple.
Okay, I have the shares.
The very first thing you do, literally within seconds of the fill, is place your stop loss.
The eject button.
You eject button. The mathematical models dictate the stop loss must be set at $320.
Okay, 320. I need to deduce where that number comes from. Why not 315? Why not 325? Why is 320 the mathematical line in the sand?
Because 320 is strategically positioned just below two incredibly critical mathematical support floors.
Okay, what are the floors?
If we look at the tactical data, the first floor is the Fibonacci 0.236 retracement level, which sits exactly at $320.54.
Okay, and the second?
The second floor is the 100-day simple moving average, which is currently sloping upward and sits at $321.70.
Okay, we have to stop and dive into Fibonacci for a second.
Sure.
For those newer to the deep technical side of trading, hearing the word Fibonacci can sound a bit like financial astrology.
It really can.
I mean, we are talking about Leonardo Fibonacci, an Italian mathematician from the 13th century who discovered a mathematical sequence: 0, 1, 1, 2, 3, 5, 8, 13, and so on.
Where each number is the sum of the two preceding ones.
Exactly. And as the sequence progresses, the ratio between the numbers approaches the golden ratio of 1.618.
Which is fascinating in itself.
Right. This ratio appears everywhere in nature. The spiral of a nautilus shell, the arrangement of leaves on a stem, the shape of a hurricane.
It's everywhere.
But how on earth does a 13th century mathematical sequence dictating the shape of a pine cone apply to millions of people trading Apple stock on their iPhones?
Well, it is one of the most fascinating psychological phenomena in finance. The financial markets are ultimately just a massive aggregate of human behavior.
A giant crowd.
Exactly. It's the collective expression of human greed and human fear. And human crowd psychology, surprisingly, tends to expand and contract in natural rhythms that closely mirror these Fibonacci ratios.
So when a stock makes a massive move from, say, 100 to 200, it rarely stays at 200.
No, it pulls back as people take profits.
And those pullbacks predictably stop and reverse at these specific Fibonacci percentages, like 23.6%, 38.2%, 61.8% of the total move.
Exactly. The 0.236 level, or 23.6% retracement, is considered a very shallow pullback.
Meaning the buyers are still really eager.
Right. It indicates that the underlying trend is exceptionally strong because buyers are eager to jump in even on minor dips.
That makes sense.
But the real reason these levels work so reliably today, however, is a mix of that natural psychological rhythm and a massive self-fulfilling prophecy.
A self-fulfilling prophecy. How so?
Because thousands of institutional algorithms and millions of retail traders are all drawing these exact same Fibonacci lines on their charts.
Ah.
And because they all see the same lines, they all place their buy orders at those exact same levels.
The math works because everyone agrees the math works.
Pretty much.
And combined with that 100-day simple moving average, which is just the average closing price of Apple over the last 100 trading days, acting as a historical consensus of value, you basically have a dual-layer concrete floor in the low 320s.
Which is precisely why our stop loss goes at 320 even. You are taking your emergency exit parachute and tucking it safely underneath that double-layered concrete floor.
Right, so if it breaks.
If the price breaks through the Fibonacci support and it breaks through the 100-day moving average, it means the structural integrity of the entire V-shaped breakout has collapsed.
The floor fell out.
Yes. The thesis is mathematically invalidated. You do not want to hold the stock anymore. The stop loss at 320 takes you out with a small, manageable loss before the roof caves in.
Okay, the defensive architecture is set. We buy the breakout at 335. We set our disaster prevention exit at 320. Now for the offense.
The fun part.
Right. What is our target? Where do we take our profits, close the trade, and go home?
The tactical target exit price is $350.
$350.
This price level aligns with a major historical psychological resistance barrier and the calculated upper mathematical boundary of the V-shaped recovery pattern.
Okay.
Furthermore, your holding horizon, the time you expect capital to be tied up in this specific trade, is very short,
How short?
just 1 to 2 weeks.
Oh, wow. That is fast.
Very fast. The objective is to ride the momentum of the pre-earnings run-up or capture the immediate post-earnings volatility pop and then exit the position entirely.
Let's do the cold math on the risk-to-reward ratio here, because this is the beating heart of mathematical trading.
It really is.
Let's hear it. We set the trap and enter at 335. Our hard stop loss is at 320. So 335 minus 320 means we are strictly risking exactly $15 per share.
Right.
Our target is 350. So 350 minus our entry of 335 means we stand to make exactly $15 per share.
Okay.
We are risking $15 to make $15. That is a 1.00 risk-to-reward ratio. It is perfectly symmetrical.
It is a 1-to-1 trade. You are risking 1 unit of capital to gain 1 unit of capital.
Is that good?
Well, in the broad landscape of trading, taking a 1-to-1 ratio trade requires you to have a win rate of greater than 50% just to break even after trading fees.
That sounds tough.
It can be. However, given Apple's structural relative strength against its peers, the extreme momentum of the V-shaped breakout, and the impending fundamental catalyst of the earnings report, the statistical probability of success here leans heavily in the trader's favor.
So it's highly probable.
Yes. The high probability of the breakout succeeding justifies taking a balanced 1.00 ratio.
So Apple represents the strategy of buying into strength, setting a trap above the ceiling and riding the elevator up.
Yes.
It's clean, it's logical, but what does the math say when a stock completely falls off a cliff?
A very different scenario.
When the elevator cable snaps and the stock is in free fall, can you trade a disaster mathematically?
You absolutely can.
Let's turn our attention to an absolute post-earnings bloodbath. Tesla, ticker TSLA.
This is a completely different psychological, fundamental, and mathematical setup than Apple.
I can imagine.
With Tesla, we are looking at massive, visceral capitulation following its Q2 2026 financial report, which was released on July 22. It was, by all accounts, a slaughter.
The numbers were brutal, specifically on the bottom line. Adjusted earnings per share came in at 33 cents.
Which was a huge miss.
Massive. The consensus on Wall Street was expecting 50 cents. That is a massive 34% miss on profitability.
That'd be disappointing.
But the weird thing is, if you look at the top line, they actually beat their revenue estimates, bringing in a massive $28.24 billion.
Which usually the market likes.
Right. But the market did not care about the revenue beat. They ignored it completely. The stock plummeted on the earnings miss. It is down a staggering 16.55% in just 30 days.
Incredible drop.
Currently trading way down around the $313 level.
The market punished them severely for margin compression.
Explain margin compression.
This is a fundamental economic reality. When an automaker continuously cuts the retail prices on their cars in order to drive sales volume and maintain market share against rising competition.
Especially from the international EV makers.
Exactly. When you do that, your top-line revenue stays high because you are selling a lot of units. But your gross profit margin per vehicle evaporates.
You're selling more cars but making less money per car.
That is exactly what the earnings report showed. The volume was there, but the profit was gone. And the institutional selling that followed was violent and indiscriminate.
But here's where it gets really interesting. Our tactical sources are actually outlining a buy setup for Tesla.
They are.
We are talking about building a disciplined mathematical portfolio today, and yet this setup requires buying a stock that is in absolute freefall.
It seems counterintuitive.
The old Wall Street adage is that trading a falling stock is like trying to catch a falling knife. It usually ends with you bleeding out.
Often true.
So how is stepping in front of a 16% Tesla sell-off not just a desperate emotional gamble? How does math justify catching the knife?
Because we are not guessing where the bottom is based on a gut feeling or blind hope.
Okay.
We are relying on the mathematical principles of statistical mean reversion and structural seller exhaustion, backed by a hard, mathematically defined stop loss.
Mean reversion.
Yes. This is what we call a counter-trend setup. You are betting against the immediate momentum because the momentum has stretched too far too fast.
Okay, mean reversion. Let's break that down for the listener. I want to try to visualize this.
Right.
Imagine holding A thick rubber band. The stock's historical average price is the dead center of the rubber band.
Right.
When buying and selling pressure are normal, the rubber band stretches a little bit up, a little bit down, but it naturally snaps back to the middle. It reverts to the mean.
Exactly.
But in a massive capitulation event like Tesla's missed earnings, the sellers grab that rubber band and they stretch it down to its absolute physical limit.
Pulling it as hard as they can.
Right. Mean reversion is the mathematical principle that once the selling pressure is completely exhausted, once there is literally no one left in the market who wants to sell the stock at these depressed prices, that rubber band is going to snap back violently in the other direction.
That's the theory.
It doesn't mean a new multi-year bull market has magically started. It just means the rubber band has to normalize to relieve the extreme tension.
That is an excellent visualization of the mechanics at play. And in mathematical trading, we don't just guess when the rubber band is fully stretched.
We don't.
No, we have specific tools to measure the exact tension. We measure how stretched the rubber band is using a momentum oscillator called the Relative Strength Index, or RSI.
Let's deep dive into the RSI. What is the actual math happening under the hood of the Relative Strength Index?
The RSI measures the speed and the magnitude of recent price changes to evaluate overvalued or undervalued conditions.
It's a scale, right?
Yes, it is plotted on a scale from 0 to 100. Mathematically, it is calculating the average percentage gain of the stock on its up days over a set period, usually 14 days, and dividing it by the average percentage loss on its down days.
So if a stock has been going down 5% every day for 2 weeks, the formula heavily weights the downside momentum.
Which drives the RSI number lower and lower.
Generally speaking, the textbook definition is that any RSI reading below 30 is considered oversold.
Correct.
It means the rubber band is dangerously stretched to the downside.
Exactly. Now, look at the tactical data for Tesla. After that earnings plunge, Tesla's 14-day RSI is currently screaming at 18.18 on the primary data feeds.
18.
And some alternative tactical feeds have it calculated as low as 10.54.
An RSI of 10.54. That is almost unheard of for a mega cap, highly liquid stock like Tesla.
It is extremely rare.
To get an RSI that low, a stock essentially has to be going straight down aggressively day after day with zero relief bounces.
A complete waterfall decline.
That means the rubber band is stretched. So far, it's practically transparent. It's about to snap the fingers of whoever is holding it.
Exactly. An RSI of 18 or 10 indicates total absolute seller exhaustion. Everyone who is going to panic sell Tesla on the bad earnings report has already sold.
The panic is over.
There is no structural supply left to push the price significantly lower. Furthermore, the math is supported by the options market.
What are the options saying?
If we look at the options chain pricing for the July 31 expiration, the implied volatility is pricing in an expected move of plus or minus $16.68, which is about a 5.33% swing.
So the options market is bracing for a violent snap.
Yes, which is driven by complex Black-Scholes pricing algorithms. And finally, we have the statistical math of historical seasonality.
Seasonality, like summer versus winter.
Kind of. If you backtest Tesla's performance over the last decade and a half, August is historically its strongest month of the year.
Oh, wow. Really?
Yes. It boasts a 57% win rate in August, with an average return of plus 7.9%.
So we have a confluence of data, a mathematically stretched rubber band via the RSI, options, market volatility, pricing in a big move, and historical seasonality, all pointing to an imminent bounce.
Everything aligns.
The math is screaming for a mean reversion. So what is the blueprint? How do we execute the catch of this falling knife safely without losing our fingers?
Well, because we are trying to catch a bottom on a falling asset, we absolutely do not use a buy stop order like we did with Apple.
Right, because a buy stop buys into upward momentum.
And here, there is no upward momentum yet. We use a limit buy order. We are essentially placing a mathematical net below the current price, waiting for the stock to fall into it.
A limit buy order. You are telling your broker, I will buy these shares of Tesla, but I will not pay a single penny more than this specific predetermined price.
You dictate the terms to the market.
Right.
The proposed entry trigger, according to our tactical sources, is a zone between $306.50 and $310 even.
So we want to accumulate shares as the lingering selling pressure pushes the stock down into that psychological support zone. And the eject button, the stop loss. Because if we are catching a falling knife and the knife slices right through our limit buy net, we need to let go immediately before it severs an artery.
Yes, the stop-loss discipline must be incredibly rigid on a counter-trend trade. The math dictates it goes exactly at $295.
Let me look at the chart and deduce why 295. Okay, I see it.
To see the floor.
Yes, Tesla has a massive multi-month 52-week low sitting right at $297.82.
That price is the concrete floor of the basement.
The last time Tesla was in trouble, buyers defended that 297 level with their lives.
They did.
If the stock breaks below 297.82 now, it means the fundamental thesis of the company is entirely broken.
It means there is a trapdoor underneath the basement.
And the stock is going much, much lower. So we set our stop at 295 to give it a tiny bit of mathematical wiggle room around that 297 level.
But if it hits 295, the mean reversion thesis is dead. You are out. No questions asked.
Perfect analysis. Okay, we are in at, let's assume, an average execution price of 308. Our stop is firm at 295. What is the target for the mean reversion bounce?
The target exit price is $335.
Which is exactly where the stock was trading before the earnings report broke the floor.
Precisely. We are targeting a mathematical retest of the near-term pivot point that broke during the earnings drop.
So we aren't being greedy.
Not at all. We aren't expecting Tesla to magically go to all-time highs and save the world. We are strictly expecting the rubber band to snap back to the previous floor.
And in technical analysis, previous support, the old floor almost always becomes the new resistance, the new ceiling.
Right. Once it hits 335, it will hit its head. So we take our profits and exit.
And the holding time.
As for the holding horizon, you are looking at 2 to 4 weeks. You have to give the extreme oversold conditions time to unwind and transition into that strong August seasonality data.
So let's run the risk-to-reward ratio on catching the knife. This is where the math really shines. If we get filled in the middle of our limit zone at 308 and our stop is at 295, we are risking $13 a share.
Right.
Our target is 335. So 335 minus our 308 entry means we stand to make $27 a share.
Correct.
Risking $13 to make 27. That is a risk-to-reward ratio of roughly 0.48.
You are risking roughly 50 cents to make a dollar. This is what we call a highly asymmetrical trade.
Because the downside is capped.
Yes, because you are buying an asset at extreme distress levels right next to a massive historical support floor, your downside risk is mathematically constrained.
But your upside potential, the rubber band snap, is more than double your risk.
This is exactly how institutional algorithmic traders view the world. They do not care that the headlines on Tesla are terrible.
They don't care about the news.
They don't care that the CEO is controversial. They care that the mathematical ratio is 0.48.
It's geometry and ratios, not emotion and narrative. I love the contrast.
It's powerful.
Okay, so we've looked at tech momentum, buying the ceiling break with Apple, and we've looked at tech capitulation, catching the falling knife with Tesla.
Both very different setups.
But a purely mathematical portfolio requires architectural balance. We cannot just be swinging around high beta tech stocks all day.
No, you'd get whiplash.
If the Nasdaq has a bad week, our whole portfolio goes down. We need diversification into traditional structural value. We need a stock that behaves a little more predictably, a bit slower.
We need a financial stock.
Yes. Let's look at the financial sector. Enter American Express, ticker AXP.
American Express gives us an excellent opportunity to analyze a classic pullback retest setup.
Pullback retest.
Fundamentally, AXP is a very strong, highly profitable blue chip company.
It's a powerhouse.
But in the near term, our tactical sources are identifying significant signal deterioration heading into their earnings.
Signal deterioration, like what?
For example, the proprietary bar chart technical algorithms recently downgraded their overall buy signal on AXP, dropping it from 56% down to 40%.
Oh, wow, that's a big drop.
And the stock is currently under pressure, trading below both its 50-day simple moving average, which is at $347.91, and its 200-day simple moving average, which is sitting at $345.54.
For the listener, we really need to talk about the 200-day moving average for a second.
It's important.
When a stock falls below its 200-day moving average, Traditional textbook technical analysts usually view that as a massive, flashing red bearish signal.
It's the ultimate warning sign for many.
It means the average price over the last year is broken. The long-term trend has completely fractured.
Yes.
So if the algorithms are downgrading it and it's below the 200-day moving average, why on earth are our tactical sources highlighting American Express as a mathematical buy?
Because of the precise location where the selling pressure is exhausting. Similar to the Tesla setup, we are looking at an oversold RSI indicator.
Ah, the RSI again.
AXP's 14-day RSI is deeply oversold at 29.02.
A low 30.
Right. But the critical difference is the asset class. Tesla is a highly volatile, narrative-driven growth stock. American Express is a mature structural financial institution with massive institutional ownership.
It moves differently.
The math suggests that the initial knee-jerk selling pressure from retail traders is exhausted, and the stock price is currently sinking down into a major long-term structural pivot point.
So what does this all mean? Let me try to build a new visual to simplify this structural pivot point concept for the listener.
Okay, let's hear it.
Imagine the stock dropping as a heavy bowling ball falling out of the sky onto a massive trampoline.
Ooh, a trampoline.
Yeah. The heavier the object hits the mat, the deeper it sinks into the fabric. That depth, the stretch of the fabric, is your oversold RSI of 29.
It's stretching the mathematical limits of the trampoline.
Exactly. But right underneath that black fabric are the physical heavy-duty metal springs.
The support.
That is your structural pivot support, in this case, what technical analysts call the classic S3 pivot level. The deeper the RSI stretches the mat, the closer it gets to engaging those heavy metal springs, creating the mathematical probability of a massive upward bounce.
Because the downward kinetic energy has to be converted and released upward.
Exactly.
That is a brilliant way to conceptualize it. The S3 pivot level for American Express is currently sitting right at $320.27.
That's where the springs are.
That price level is exactly where the heavy metal springs of the trampoline are located. So our tactical execution order is a limit buy.
Like with Tesla.
Yes. And we want to accumulate shares right as the bowling ball hits the mat and stretches the fabric to the limit. We want to execute in a trigger range between $320 and $324.
We want to buy it while it's actively sinking into the trampoline, fractions of a second before the springs fire and launch it back up.
Correct. And because this is a structural value play resting on major support, our stop loss must be placed entirely below the entire trampoline apparatus.
Where is that?
We set the hard stop at $312. This is safely below the monthly support zones and the historical structural price channels.
So if it hits
312. If the stock hits 312, it means the bowling ball was too heavy, the spring snapped, the trampoline is busted, the thesis is wrong, and you need to walk away immediately.
and the target for the bounce, where does the trampoline launch us back to?
The tactical target exit price is $345.
Which is,
Okay,
let me check the data, exactly where the 200-day moving average is currently descending.
yes.
Okay, we have to explain the why here. Why does the stock bounce up to the 200-day moving average and then stop? Why is that our target?
This goes back to the human psychology embedded in the math. Think about all the investors who bought American Express 6 months ago when it was trading above that 200-day moving average. When the stock crashed through that floor, they were suddenly trapped in a losing position. They are underwater.
Oh man, they are staring at red numbers in their portfolio every single day, just feeling the stress.
Exactly. When our trampoline bounce launches the stock back up to 345, the stock reaches the exact price where those trapped investors originally bought it.
Oh, I see. And what do people do when they've been stressed out about a losing trade for months and suddenly, miraculously, the stock gets back to the price they bought it at?
They sell instantly.
Just to get out.
They say, thank goodness I can get out of this at break even, and they dump their shares.
That is so human.
It is. That psychological relief selling creates a massive wall of algorithmic and retail supply right at the 200-day moving average.
So the old support floor mathematically becomes the new resistance ceiling.
Right. You expect the stock to hit its head violently on that 200-day moving average. So you take your profits right there at 345 before the trapped buyers can push it back down.
That is fascinating. The math is just a map of human trauma and relief.
Basically.
But this raises an important question. Let's look at the holding time for American Express.
The horizon.
Yeah, the tactical outline says 1 to 3 months. That is significantly longer than the 1 to 2 weeks for Apple or the 2 to 4 weeks for Tesla. Why is the math demanding we sit in this trade for up to a financial quarter?
It comes down to asset class beta and sector volatility. Tech stocks like Apple, Tesla, Nvidia, they move at light speed. They have incredibly high beta.
To fly around.
Retail and institutional capital flows in and out of them like water through a fire hose. Financial stocks, on the other hand, especially blue-chip credit companies like American Express, move much slower.
It's heavier money.
The institutional money that buys AXP, pension funds, mutual funds, endowments, is slower, heavier, and more methodical.
Right.
Therefore, to capture a $25 move in AXP, you mathematically have to allow for a much longer time horizon.
Right. You cannot expect a 170-year-old financial stock to behave like an electric vehicle momentum stock.
Exactly. You have to match your patience to the mathematical profile of the asset class.
Okay, let's run the risk-to-reward ratio on the AXP trampoline downs.
Let's do it.
Assuming we get our limit execution right in the middle of our target range at $323, our hard stop loss is placed under the springs at $312. So 323 minus 312 is a defined risk of exactly $11 per share.
Right.
Our target is the 200-day moving average at 345. So 345 minus our 323 entry means a potential gain of $22 per share,
Okay.
risking $11 to make 22.
Which is exactly a 0.50 risk-to-reward ratio. Once again, heavily skewed in your favor.
You are risking $1 to make $2.
Yes. When you combine that 0.50 ratio with a major structural support level and a deeply oversold RSI, the mathematics of the trade are exceptionally sound.
All right. We are building a truly balanced machine here.
It's coming together nicely.
We've looked at tech momentum, buying the breakout. We've looked at tech capitulation, catching the falling knife. We've looked at financial value, playing the trampoline bounce off structural support.
3 solid pillars.
Now, what does the instrument panel say about a stock that simply defies gravity? A stock that refuses to stop going up month after month, year after year.
These are fun ones.
Most people assume it's too late to buy. Let's transition to the biotech sector and look at the absolute behemoth, Eli Lilly, ticker LLY.
Eli Lilly is a fascinating masterclass in trend-following momentum. It is currently operating within a massive, medium to long-term rising trend channel.
It's just massive.
It has been driven fundamentally, of course, by the explosive, unprecedented growth and demand in their GLP-1 weight loss therapeutics.
The demand is insane.
It is. Mathematically, the stock is a juggernaut.
If you look at the chart, it's just a line that goes from the bottom left of your screen to the top right, constantly, with almost no meaningful pullbacks.
Yes. And the momentum indicators confirm the strength of that trend. The MACD, the Moving Average Convergence Divergence Indicator, is currently sitting at a highly positive 7.45.
Okay, let's unpack the MACD. We hear that acronym thrown around on financial television all the time, usually by guys in suits yelling over each other.
Right. The MACD is crossed.
Exactly. What is it actually measuring under the hood?
The MACD is a trend-following momentum oscillator. It is designed to reveal changes in the strength, direction, momentum, and duration of a stock's trend.
How does it do that mathematically?
Mathematically, it is calculated by subtracting a longer-term exponential moving average, usually the 26-day EMA, from a shorter-term exponential moving average, usually the 12-day EMA.
And an exponential moving average is different from a simple moving average because it gives much more mathematical weight to the most recent days, rather than treating all 26 days equally.
Exactly. It reacts faster to new information. So when the shorter 12-day moving average pulls away from the longer 26-day moving average in an upward direction, the MCD prints a positive number.
What does that prove?
It mathematically proves that recent immediate momentum is accelerating faster than historical momentum. A heavily positive MACD of 7.45 confirms that the bullish trend in Eli Lilly is not just intact, it has massive accelerating velocity behind it.
The train is speeding up.
Yes.
But if I look closely at the dashboard, one of the warning lights is blinking yellow, isn't it? Our tactical sources mention a bearish divergence on the RSI curve for Eli Lilly.
They do.
Explain how a stock can be accelerating according to the MACD, but showing a bearish divergence on the RSI.
This is one of the most crucial concepts in technical analysis, as the absolute price of Eli Lilly's stock has continued to march higher, making new all-time highs, climbing the staircase, so to speak.
Right.
The RSI, which measures the internal strength and speed of those upward moves, has actually been making lower highs.
Lower highs.
Imagine a marathon runner running up a series of steep hills. The first hill, they sprint up it with incredible energy. The second hill, they make it to the top, but they are breathing much heavier.
Okay, I see where this is going.
The third hill, they still reach the peak, but they are jogging slowly, completely exhausted. The runner's elevation, the stock price, is still going up. They are higher than they were before.
But they are running out of gas.
But the underlying momentum, the internal biological energy measured by the RSI, is rapidly waning. That is a bearish divergence.
It mathematically warns us that the runner is tired and a pullback or a period of rest is highly likely.
Precisely.
So we have a stock in a massive historic uptrend, a positive massity showing velocity, but the runner is getting exhausted according to the RSI divergence.
Right.
And they have a massive fundamental catalyst approaching with their earnings report on August 5. What is the mathematical execution for trading this beast? How do you buy a tired runner without getting trampled?
Well, because it is such a strong, historically robust primary trend, we do not want to try and catch a deep pullback.
Okay.
We want to buy on a minor, shallow dip, specifically bouncing off its short-term moving average. The tactical execution is either a market on close order on a down day or a limit buy order.
Where is the entry?
The specific target entry range is between $1,190 even and $1,196.03.
Okay. 1190 to 1196. Why there?
This price zone is precisely where the 20-day simple moving average is currently providing dynamic support.
Dynamic support, meaning unlike a horizontal line on a chart, this floor actually moves up every single day as the stock rises.
Right.
The 20-day moving average acts like a rising escalator right underneath the stock. Okay, so our entry is roughly 1196. Where is the stop loss? Where do we admit the trend is broken?
The stop loss is placed at $1,134. This tucks it safely below the 50-day simple moving average, which is currently sitting at 1129.42.
So if the 50-day breaks?
If the 50-day moving average breaks, it means the primary trend is officially fractured, and that bearish divergence we discussed on the RSI has played out fully. The runner has collapsed. You want to be out of the trade.
And the target for the continuation of the trend?
$1,250. We are targeting a retest of its recent all-time highs, assuming the earnings report provides the fundamental fuel to keep the trend alive.
And how long are we holding this?
The whole time is short, just 2 to 3 weeks, aiming to capture the momentum going into and immediately following that August 5 earnings report.
Okay, wait a minute. Hold the phone.
What is it?
I am looking at the risk-to-reward ratio here, and I have to push back. I have to challenge this because it violates the core mathematical rule we've been building this entire time.
Oh, let's hear the math.
Let's do the math. Assuming an entry of 1196, our stop loss is at 1134. That means we are risking $62 per share.
Okay.
Our target is 1250. So 1250 minus our 1196 entry means we stand to gain $54 per share.
Right.
We are risking $62 to make $54. That makes the risk-to-reward ratio 1.15. We are risking more money than we stand to gain.
Yes, we are.
Every other setup today has been risking $1 to make 2, or at least risking 1 to make 1. How on earth is an inverted risk-to-reward ratio mathematically sound for our listener?
It is a fantastic question, and it cuts to the absolute core of how algorithmic probability matrices function in trading.
Okay, enlighten me.
You have to understand that risk-to-reward ratios do not exist in a vacuum. They are intrinsically linked to the statistical probability of the event occurring.
Explain that.
When you trade a mean reversion falling knife setup like Tesla, your statistical probability of catching the exact bottom of the capitulation is low. You might only be right 30% or 40% of the time.
Right.
Because you are going to lose more often than you win, the math demands that your winning trades must pay out at least twice as much as you risk in order for your portfolio to remain profitable over 100 trades.
That makes sense. That is why Tesla requires a 0.50 ratio.
Exactly.
If you strike out 60% of the time, then when you finally do hit the baseball, it has to be a home run. Otherwise, you lose the game.
Exactly. But Eli Lilly is the exact opposite mathematical profile. This is a trend-following setup. The stock is in a confirmed, historically robust, massive primary uptrend.
Okay, so the trend is your friend.
The RSI is currently sitting at a healthy 61.56, meaning it is cooled off from its divergence and is not yet overbought.
Right.
The mathematical probability of a stock continuing its already established trend is significantly higher than the probability of it suddenly reversing and crashing.
It's Newton's first law of motion applied to equity markets. An object in motion tends to stay in motion unless acted upon by an outside force.
Precisely. In a high-quality trend-following setup like Eli Lilly, your statistical win rate might be 65%, 70%, or even 75%.
That's a high win rate.
And when you win 70% of the time, the math allows you to absorb a slightly inverted risk-to-reward ratio of 1.15.
Oh, I see.
You are intentionally trading a smaller potential payout in exchange for a much higher mathematical certainty of success. It is a different kind of edge, but it is just as valid mathematically as the Tesla setup. You are buying probability.
That is an incredible insight. The math changes based on the probability of the event.
It does.
Okay, we have our 4 primary equity setups locked in. We have Apple for the V-shaped breakout momentum, Tesla for the extreme oversold capitulation bounce, American Express for the structural trampoline support, and Eli Lilly for the high probability trend continuation.
A beautifully diverse portfolio of setups.
But to complete this purely mathematical 5-stock system, we need to address the massive dark storm clouds we talked about in the very beginning of the deep dive.
The macro dashboard. The external turbulence.
Exactly. Inflation and rising energy costs. We said earlier that if Brent crude oil hits $102, or if the 10-year yield spikes to 4.72%, the algorithms will indiscriminately dump high beta growth stocks.
That's the trigger.
Well, Apple and Tesla are both high beta tech stocks. If that macro trigger hits, the fundamental gravity changes, and those stocks are going to feel immense pain. They might both hit their stop losses simultaneously.
They very well might.
So how do we mathematically hedge that portfolio risk?
We need a counterweight. We need to introduce an asset into the portfolio that structurally benefits from the exact same macroeconomic forces that would harm our tech holdings.
We need an inflation parachute.
Yes. Enter ExxonMobil, ticker XOM. This is our commodity breakout play, and it acts as the perfect algorithmic macro hedge for the entire system.
Let's look at the technical structure of Exxon. If oil is threatening to break out, Exxon must be looking strong.
It is. Exxon is currently operating within a textbook, ascending rising trend channel. But what is most compelling here, mathematically, is the volume analysis.
Volume. We haven't touched on volume yet.
In technical analysis, we have a saying. Price is what is happening, but volume is the truth behind it.
Let's unpack volume confirmation. Why is counting the number of shares traded so critical to validating a trend?
When the stock's price goes up on low trading volume, the move is highly suspect. It means it didn't take a lot of buying power or capital to move the price.
It's weak.
It implies the trend is fragile, driven by retail traders or light algorithmic rebalancing. But when a stock price goes up on massive surging volume,
Then what?
it means heavy institutional money, hedge funds, sovereign wealth funds, pensions. They're aggressively accumulating the stock. They're deploying billions of dollars.
Paired with Exxon.
With Exxon, every single time the price pushes higher toward the top of its channel, the volume spikes massively. The big money is systematically accumulating energy assets.
Because they're reading the exact same macro dashboard we are?
Yes, they are.
They are preparing for that exact scenario we discussed. They are preparing for structural inflation to stick around, for oil to break 102, and for tech to falter.
They're hedging their bets.
So what are the strict trade parameters for Exxon as our portfolio parachute?
We want to execute a limit buy order to catch minor pullbacks within the immediate breakout zone. The proposed entry range is between $154.50 and $157.
And the stop loss. If the inflation thesis is wrong, where do we cut the parachute?
The stop loss is placed at $146. This is strategically positioned just below a massive multi-year structural support zone at $147.
And the target exit?
$171. This represents the upper resistance line of a long-term multi-year trend channel.
And how long do we hold it?
The holding time is 1 to 2 months, giving the complex global energy cycle time to play out following their earnings report.
Let's do the math on the hedge.
Yeah.
Let's say we get our limit buy filled at $156. Our stop is at 146, so we are risking exactly $10 per share.
Right.
Our target is 171. So 171 minus 156 is a potential gain of $15 per share.
Okay.
Risking $10 to make 15. That is a risk-to-reward ratio of 0.67. Highly favorable.
It is a mathematically excellent hedge. However, the instrument panel does have one warning light that we must acknowledge.
Okay, what is it?
The RSI for Exxon is currently sitting above 70.
And earlier, during the Tesla segment, we established that an RSI below 30 is oversold, like a rubber band stretched down to the floor.
Yes.
An RSI above 70 means the mathematical opposite. It's overbought. The rubber band is stretched tightly to the upside, nearing its breaking point.
Correct. An RSI over 70 indicates very strong, dominant, positive momentum, but it also mathematically warns that the stock is historically overextended in the near term and highly susceptible to a sudden reaction downward as traders take profits.
So it needs to cool off.
That is precisely why we are using a limit buy order to enter on a pullback, rather than simply buying it at the market price right now.
Right.
We demand that the RSI cool off slightly, that the rubber band relax just a bit before we commit our capital to the hedge.
If we connect this to the bigger picture, I look at this Exxon trade, and really this entire five-stock portfolio construction, like counting cards and blackjack.
Counting cards?
Yeah. When you count cards, you don't just blindly bet on the two cards you were dealt in isolation. You bet based on the mathematical composition of the entire deck remaining in the shoe.
Oh, I like that.
You know, based on a macro dashboard, that there are a lot of face cards left in the shoe. Sticky inflation, energy constraints, geopolitical tension. So you increase your bet on a hand that structurally benefits from face cards dropping.
ExxonMobil is the insurance bet on the table.
Exactly. If the Brent crude trigger of 102 is hit, Apple might get crushed and trigger its $320 stop loss. Tesla might get crushed and trigger its $295 stop loss.
And you will take those mathematical losses.
But the massive profits from the Exxon trade act as the parachute for those tech drawdowns, keeping the overall net value of the portfolio mathematically sound and protected.
That is the absolute essence of professional portfolio construction. You aren't just blindly picking 5 isolated stocks and hoping they all go up.
No.
You are building an interconnected, heavily researched mathematical ecosystem where the individual components balance and hedge each other against unforeseen macroeconomic shocks.
Okay, we have covered an immense amount of ground today. We have put the market in the X-ray machine and built our 5-stock mathematically pure portfolio.
A very strong list.
We have Apple for V-shaped breakout momentum, utilizing a buy stop to confirm strength. We have Tesla for extreme oversold mean reversion, catching the knife with a limit buy.
Yes.
American Express for structural support bounces off the 200-day moving average. Eli Lilly for high probability trend continuation, accepting a 1.15 risk ratio. And ExxonMobil as the algorithmic volume-bagged inflation hedge.
It is a robust, highly tactical mathematical plan that respects both the micro-technicals and the macro environment.
It really is.
But having the data, having the plan, is really only 10% of the battle.
Exactly.
Yeah.
I want to talk directly to you, the listener, right now as we close this out.
Listen closely.
You can have the most beautifully constructed mathematical spreadsheet in the world. You can memorize every Fibonacci sequence, understand the calculation of every moving average, and spot every RSI divergence like a seasoned professional.
But it won't matter.
No, it won't, because the other 90% of trading, the part that actually determines if you survive or blow up your account, is having the cold, ruthless discipline to execute the plan without second-guessing yourself when the bullets start flying.
Because the market will test you.
It will. When your stock loss on Tesla at $295 inevitably hits, and your brokerage screen is flashing blood red, and the financial news networks are screaming that the company's going bankrupt and the stock is going to 200.
Human biology will take over.
It will.
Yeah.
Your instinct will tell you to hold on, to hope it bounces, to manually cancel your stop loss order just to give it a little more room.
And the second you cancel that stop loss, you are no longer flying the plane on instruments.
No, you're not.
You have looked out the window at the storm, you have panicked, you are flying blind, and you are going to crash the plane.
It happens every day.
By stripping away brand loyalty, by ignoring the news cycle panic and removing emotional attachment, trading simply becomes an exercise in geometry and statistics.
Numbers on a screen.
Stop losses aren't suggestions, they aren't guidelines, they are the mathematical foundation of your financial survival.
I will leave you with a final, slightly provocative thought to mull over as you review these charts on your own time.
Let's hear it.
We have spent this entire deep dive building a system based 100% on mathematical indicators. We've looked at the 200-day moving average on American Express, the RSI capitulation on Tesla, the MCD velocity on Eli Lilly.
Right.
We trust the math because everyone else trusts the math. But ask yourself this.
Okay.
If every single institutional algorithm on Wall Street and millions of retail traders around the world are looking at these exact same moving averages, the exact same Fibonacci levels, and the exact same RSI divergences, what happens to the mathematical laws of physics when the machines all try to squeeze through the exact same exit door at the exact same time?
Wow. Does the floor become the ceiling? Does the math fundamentally break?
It's something to consider.
It's a chilling thought to leave on, but until that day comes, you keep your eyes locked on the dashboard. You trust your instruments. And you respect the storm outside the window. That's all for today's deep dive into the numbers. Stay disciplined out there.